So to get the ball rolling, there were some that were asked people that can't be here. A couple of you have focused tonight on the best companies you've had and some really good success stories. What would you say was your worst?
I don't mind going with that.
Yeah.
So we've had 20 investments from the Startup Series Fund. We've had 4 failures. 3 of them were only invested at SEIS. So hideously painful for us, also hideously painful to the entrepreneurs involved. But we had one that was EIS, and that was was bang on trend for market, a vegan restaurant chain, or start of a vegan restaurant chain. Product was great, but the 2 founders were very, very close friends and just kind of mentally didn't really cut it. And one of the things that we learned from that was, one, we put in place a little bit more strength around our psychometric testing at the initial evaluation stage. There's only so much you can do with that. Psychometrics in the startup space aren't actually that great. Most psychometric testing has been developed with corporates, and it's different kind of psychometrics that you're testing for. But I think what Paul and I really learned from that is we needed to be a bit more, how shall I say it, sensitive. We're both quite robust and successful individuals, and sometimes through our careers we've been accused of being a little bit robust in the way that we do things. And I think we're a little bit more sensitive now to the kind of mental health of the entrepreneurs that we're dealing with, and put in various different ways that we can flush stuff out a bit earlier.
Anyone else? You don't have to answer, it's just if there's one that you think is relevant.
Just on reflection, not really specific companies to mention as to why they failed as such, just put into context the life cycle. So we invest at SEIS level, and we also try to promote it to EIS, not all of them, but some of them. Some of our SEIS companies stayed up at cost for pushing 5 years. If they've not shown growth or potential in that stage, it's probably best for investor interest to write them off and then obviously not take the loss from it.
We've had 2 SEIS failures, none on the EIS, but we assume there would be some. But the one thing that we did do, a lot of you have probably heard from what happened with Oxford Capital, and one of the big complaints is that the portfolio went from par to 0 with no warning. So we had a company called PlayStack that went bust in September, and if you got our August statement, it said it was down by 90%. And it had been marked down, I think, 2 or 3 times. So we have some that we do mark down, so that there shouldn't be any surprises, but of course there are some.
Okay. The other question we had, which if you can all answer, would be great, but how do you actually tell? A lot of you invest, we're now in a growth market, so a lot of you invest in tech or different areas and they're all great businesses. How do you pick your target returns? Because obviously they do differ quite, not wildly, but they do differ. So yeah, how do you sort of come up with the formula? Do you want to start us off with me?
Not really, because I don't particularly understand the question.
So, some of you want to start off. So Steve starts off.
Yeah, so our tech growth, for example, is £1.60 on the target. We base that on 5 investing companies in each portfolio. You invest and you get 5 investing companies. 1 or 2 may fail, 1 or 2 may break even or slightly above, and 1 does at least 3 times return. So it comes at £1.60. That's the question.
Do you want to start that?
Yeah, that's fine. Yeah, so it's a slightly arbitrary number of topics because you build a portfolio of, in our case, 9 companies. You don't know how, you want all of them to be major successes, of course. You don't start off with the expectation that any of them are going to fail. But it's not unrealistic to think that some of them won't make it to the end. So our target is 2x, and it's slightly arbitrary, but what we think it reflects is that there's a blend of some companies that are later stage. John was reflecting earlier, which may be typically slightly lower in terms of the multiples versus some things that are slightly earlier, which may well be a higher multiple on the initial amount of capital going in. And then when you factor in some ones that don't do as well as we'd hoped, if that's a euphemism, then that's how we come to a 2x. But it reflects perhaps a slightly later stage investment philosophy.
There's not a huge amount more I can say on this actually than has been articulated by James, and still be interesting.
If that answers it.
Yeah.
Is that pretty much replicated across all of you?
Well, we're a little bit different. We're like you guys because we feed money in every year. So obviously, someone who's got even a modestly successful business that grows 3 or 4 times in the time, if you're in earlier or you're in later, that makes a difference. So we have to come up with a range that represents the last person and the first person.
And I think also it goes back to the point about failures. I mean, we hear about, and I think we're all kind of pretty similar numbers in our targets, but that's not a target for an individual business. The target for an individual business is much higher because we need to balance that across a portfolio. And we have to accept in this that the failures come early, the successes that you need to be a little bit more patient for. So, every business we invest in, we are expecting 10x, 20x, 30x, but that's not always going to happen.
The numbers I think all these numbers are pretty arbitrary. They rather reflect the kind of IRR you should receive for the given level of risk without tax breaks. So with the tax breaks, you should be getting something pretty attractive. So for instance, in our case, at 285, 50% failure rate is assumed. We have nowhere near that. We have 0 on our EIS. But you're accommodating for that. And you'll probably have some, I mean, it'll almost certainly, our model will almost certainly be completely wrong. But that's the kind of thing you should.
Just to build, because I think Keenan's nearly alluding to this actually, is that generally speaking, you have failures, you have bumblers, and then you have successes. We're actually not trying to, I'm trying to put words into the other fundamentals, but we're not trying to necessarily reduce the overall number of failures. Where the returns come from for you guys is to maximise the returns of the winners and reduce the really annoying ones in the middle that are bumbling along that don't end up with an opportunity for exit or dividends. So that's the other way of looking at it across those sort of 3 chunks, if you like. Does that make sense?
I'm somebody who has never invested before, or for myself or for clients, in EISs, VCTs. One thing I've just noticed about Seeding, which is you've been very, very forward with regard to business failures within the funds. My question to you is, what's the attitude of the financial services service to this? Because before I'm just going to recommend, I'm going to do some stuff myself. I've already maximised my pension. So, I don't know whether it's an appropriate question to you, gentlemen, or to your good self, but what's the attitude of FOSS and how much FOSS taking?
So, all of the EIS, SEIS isn't covered by the FSCS.
Right.
So FOSS's opinion is quite straightforward. FOSS's opinion, I have my opinions on.
Yeah, fine. But what I'm trying to get at is that obviously you're not going to recommend these sort of investments to anybody other than a sophisticated investor. You're going to have a disclaimer on your suitability, etc., etc. However, what I'm trying to grasp before I start doing myself or recommending is what's the sort of view even from the room with regard to how you would deal with a particular complaint from the financial ombudsman?
Can I throw part of that? So, try and answer part of that question. What the FOS would say is did we invest in the way that we said we would do?
He's not trying to catch you.
No. I'm trying to answer differently. Is have we fulfilled what we said we would do in the information memorandum and the marketing literature? Did we invest on the basis of the way we said we would in the type of companies we said we would within the parameters? We do the due diligence we said we would, and all of those things. If we fulfil that, then whether the business has failed or not, which isn't covered by the FSCS, then the FOS generally would say, you've done what you said, you've done a very good job, but you've done what you said, and that's okay. It's when we step outside and don't fulfil what we've said we would to you as the advisor and to advise in terms of the investment process, the due diligence, the mechanics of it, that's when they'll say, there's a problem here. So that would be my reflection on it. We've got to do what we've said we would do in the IM.
And also just to round that off, so there was a letter, an open Dear CEO letter written by the regulator last week, talking about alternative investments and suitability and less of the product selection, but more of the actual EIS or VCT or whatever it may be. From their point of view, there were some quite key points in there. One was that advisors shouldn't ever, no offence, but shouldn't trust a provider's opinion, which should be a sort of given mentioned about third-party research tools, and if you just have a unnamed third-party research report on a provider and the provider's fact sheet, that's not enough, which again seems common sense. But actually where they sort of alluded to with the letter was that advisors should have a due diligence process where they have maybe a questionnaire or something sort of adaptable that they can give to a provider beforehand. So it's something that you personally as the advisor have asked and got the answers to. And that then goes back to Jamie's point about they're then held accountable to what they've said they'll do. Because if you've relied on a marketing report that's sort of fluffy over the figures, whereas if you've got a direct due diligence report that you conducted, the managers are sticking to what they have to do type of thing. But I've got some stuff on that I think that helps.
Well, it's also an advantage for you guys, isn't it? Because you are holding us to account as well, in a way that advisors can hold us to account, but you guys do as well.
Yeah.
No, the only reason I've asked that is that when a new client or client, the first thing you're thinking, not whether it's going to be good business or continue to do it, are they litigious?
Yeah.
and the thing I'm just thinking, but obviously now with the maximum allowance in pensions, it's a great opportunity. And I'm just trying to, from somebody who's looking at moving in, is to just tick the boxes. And the first thing is litigation, costs.
And I think the biggest thing actually with the way that the industry is now, the days of parking all your money with one manager are kind of gone. So that's where something like the Kuber really plays into that marketplace. Is one of the easiest ways to sort of mitigate your risks of that situation is spreading across a number of different managers rather than going, actually, I'll pick that one.
I can come back on one question with regard to somebody else, one big name, which will remain anonymous, which is VCT only.
Yep.
And what you're saying is you would, because there's a multiplicity of different managers under the Kuber platform, that would be better than using that other big name if you want to go down the VCT route. Am I right?
We're being recorded, but in
There's
reality,
an extent to which you've got typically a larger VCT. A VCT is likely to be larger than the individual companies that you get in a tranche of IS. You have a greater degree of investing company diversification within that VCT. Every new investor into the VCT, every new new round, that's more diversification. However, you are utterly dependent on that one manager's processes for vetting companies, their own corporate governance procedures, and PI firms recently have been increasing advisor PI where there isn't a breadth of manager diversification.
it comes back down to the fact that although these guys talk about entrepreneurial backgrounds and all of it, they are all very different types of people. I think you'll agree. If you blend your portfolio like you would with a normal unit trust, ISA, pension, anything else, if you've got a portfolio with 4 or 5 different fund managers or however many it may be, you're getting a different sector expertise. All the other bits will fall under it, but
But you made the sale.
I thought I'd done that already. Were there any other questions? Good. Well,
I just
Go on,
wonder, the panel thinks how long the US are going to continue now. We've left Europe and that's going to improve the chances for the US. I think. Is it?
So my understanding is the sunset clause is written until 2025.
But now we're not in Europe.
That will have to be reviewed.
It did get mentioned in the Tory manifesto.
Mm-hmm.
Yeah.
There have
I
been
didn't read that bit.
Who knows on the, it's 12th of March now. Let's keep fingers crossed.
Let's see.
If you look at from a jobs point of view, it's been a tremendous success. If you look at the last 10 years in Europe, the amount of jobs created in the UK dwarfs any other European nation. In fact, I think in aggregate they equal the UK. So it's been pretty well proven to be a big success. So it would be very hard to see, particularly this government, getting rid of the